I am sure you constantly hear about this magical process of investing, and you may have gotten ads promising you financial abundance if you do this and that with your money. All of this may seem very overwhelming and block you from actually doing something with the money that you might have saved up. Since you are young, it is probably not too much, and you may think that it's not even worth going into the realm of investing. But today I want to show you that it can make a big difference if you start learning about investing and proceed to actually invest. I will present the reasons why you should invest the money you have saved up, 4 simple ways you can actually invest, the risks of investing, and all the things you should keep in mind when doing so. Now, before we start, I want to state that this is not financial advice, but purely for informative purposes. With that out of the way, let's start with why you should get into this thing called investing. The first good thing about investing is that you can grow your wealth, so make more money out of the money that you already have. In the future, this could help you retire earlier or give you the ability to buy the things that make you happy. But more importantly, you should invest your money to protect it from inflation. Let's refresh our memory about inflation. Inflation causes your money to lose value because prices rise. It is measured in percentages on a monthly basis, so the value of €1 is compared to the value of €1 1 year ago in the same month. This means what exactly can €1 get you now, and what could €1 get you a year ago in the same month. There are 3 main reasons for inflation: cost push inflation, demand pull inflation, and money printing. Cost push inflation is essentially a chain reaction. The goods and services become more expensive to provide or to produce, usually because the price of raw materials like oil increases or because the rent for factories and storage halls increases. This then forces the businesses to pass on this price increase to the customers. Demand pull inflation is a result of a lot of people wanting the same goods, but the production not being able to keep up with this demand. A current example would be the high demand for semiconductors, also known as computer chips, which are basically in every technological device nowadays. The production cannot keep up with the demand, mainly due to the COVID-19 pandemic, and this causes a shortage and an increase in prices for phones, tablets, computers, or even cars. Lastly, the famous money printing. So if more money is in circulation, the value of money decreases. This is because people are then able to spend more money on the same amount of goods. The amount of products didn't increase, but the amount of money did increase. So more money for the same amount of products means that people are able to buy more, and therefore businesses are able to increase the prices. Now let's imagine you have €1,000 sitting around. If you don't do anything with those €1,000, the next year you will still have €1,000 in your bank, but they will only be worth €977.2. This is considering the average rate of inflation over the past 2 decades of 2.28%. But as you may know, the inflation rate has skyrocketed in the past year. It peaked in October with 11.5%, so let's see what would have happened to these imaginary €1,000. If you had €1,000 in October 2021 and didn't do anything with them, in October 2022, they would only be worth €885. So you lost €115 by doing literally nothing. I think you see the problem here, and you understand that to increase the amount of money you have, you actually have to do something with it. But what options do you actually have? There are so many ways to invest your money. You can invest into real estate, art, jewelry, cryptocurrency, government bonds, and even startups. But most of these are not that accessible. Since we are young, we probably don't have the funds to buy an apartment or a house. So we need to find other ways to invest our money. I wouldn't consider this investing, but the first option you have is put your money into a savings account. You might have been taught that you should put your money into a savings account and that at some point, if you save up a lot, you will be rich. Well, I'm sorry to destroy your dreams, but it simply doesn't work like that. Because the only way you benefit from putting your money into a savings account is through the interest rates. Interest rates are what you pay the bank for lending their money and what they pay you for lending your money. You pay or get this interest on a yearly basis, and in Europe it is decided by the European Central Bank what the interest rate is. And it currently sits at 3%. Which means that if you now put €1,000 into a savings account, in a year you will have €1,030. And the years that follow, you will benefit from something called compound interest. So you'll get an interest on the interest of the past year. So after another year, the €1,030 would not become €1,060, but €1,060.9. And after another year, it would become 1,092.727 euros. And so on, which sounds pretty decent, right? Well, think again, because you have to factor in the inflation rate. So you get the 3% interest from the savings account, but considering the current inflation of 8.5% in the past February, you would just decrease the amount of money you lose. But you are still losing money, so it's not something that you should celebrate, because you want to make more money, not just mitigate your loss. Apart from that, the interest rates could also drop to zero again, because the European Central Bank decides them depending on the current economic situation. And the second option you have is to invest your money into assets. Let me give you a short introduction to some of them. The first and most famous asset are individual stocks. Buying a stock translates to buying a small percentage of the company at a certain valuation, which can increase or decrease. If it increases and you sell your percentage, you will have successfully made money through investing. Likewise, if it decreases and you sell it, you will have lost money. You can invest into stocks long-term, mid-term and short-term, but the shorter you want to invest, the more complicated it becomes. So let's focus on long-term for now. Stocks provide a great opportunity to grow your wealth, but there are some conditions that are really important. It is crucial that you do some proper in-depth research on the company, that you evaluate the company's future and long-term potential, and that you keep up with all the news that could affect the company's stock price. Doing research means checking their financial data, see how much debt they have, see how much cash on hand they have, and how much revenue they generate. These are just a few of the internal factors that you need to do research on and keep yourself updated. Because if something goes wrong within the company, you might want to consider selling your percentage to not lose any money. Now keep in mind that you also have to be aware of all the external factors that could affect the company and thus the stock price. This means being aware if the industry as a whole is growing or shrinking, going well or going bad, and checking for their competitors. In general, there are so many factors that can influence the price of a stock that it's really hard to be aware of all of them. A further downside of investing into individual stocks is that you place all your money into one company, and this results in higher risk. In summary, you really need a lot of time to invest into individual stocks properly, and you might not have enough time to do so. In that case, there are other ways to invest your money. You could invest into a mutual fund, an index fund, or an ETF, which is also known as exchange-traded fund. To invest in these, you actually need less time because your investment is managed by an individual or by a company. Another very good thing about these three investment methods is that you spread your risk because you don't isolate your investment. What this means is that you invest into multiple companies instead of just one. Yes, you could also do that manually and research 10 companies and invest in all 10 on your own, but that obviously takes a lot of time. You could either invest 1,000 euros into one company or invest 10 euros into 100 companies. If you spread your investment and one of the 100 companies goes bankrupt, you lose 10 euros. But if you don't and you put 1,000 euros into one company and that company goes bankrupt, well, you guessed it, you lose all the 1,000 euros. Sure, you could also say, oh, but if I put 10 euros into a company and the price goes up, I won't make that much money. And that is true. So here you have to decide how much risk you're willing to take. Apart from spreading your investment, you're also able to diversify your investment through index funds, mutual funds, and ETFs. Diversifying your investment means investing into different industries or different sectors. So instead of buying stocks into technology companies like Apple and Samsung, you could buy the Apple stock and invest into Coca-Cola, so you invest into technology and into the beverage market. So this is what these three investment methods have in common. But how exactly are they different? Well, a mutual fund consists of 40 to 100 companies and is actively managed by a professional. The concept is pretty simple. You give someone your money and they try to make more out of it for a commission. The commission is usually between 1 and 2%, which doesn't sound like a lot, but if you have 10,000 euros invested, this means that you would have to pay 200 euros per year just to have the fund managed, even if you lose money. Index funds and ETFs, on the other hand, have lower management fees because the management of the stocks is rather passive. This means that there's not an individual person that decides which stocks to invest in, but that the stocks are chosen by an index. And an index is a list or a group of companies that fulfill certain characteristics. You can invest into sustainability indexes like the MSCI Sustainable Future, or into technology indexes like the Nasdaq. The most famous and popular indexes are the S&P 500, which consists of the 500 biggest companies in the United States, and the MSCI World, which consists of over 1,500 of the biggest companies worldwide. Therefore, thanks to index funds and ETFs, we have the possibility to invest into all these 1,500 companies with one transaction. The only big difference between ETFs and index funds is that ETFs can be traded throughout the whole day, while as index funds can only be traded at the end of the day. However, this is pretty irrelevant to you if you want to invest long term. Naturally, you should still use some time to investigate the companies that are part of the index and the characteristics of the index funds or ETFs. Here you should look out for operating expenses as well as the volume of the index fund or ETF. The volume is basically how much money has been invested into this index fund or ETF in total, and if it's a really small amount, you really have to be careful and see who is actually behind this index fund or ETF. It is also very important in the case of an ETF to check if it's a distributing or accumulating ETF. Distributing ETFs pay you the amount that your ETF has increased in value in a certain time period, usually 3 months, 6 months, or 12 months. So if you have 1,000 euros in this ETF and it increases in 5%, you will be paid out 50 euros. This can be good depending on your goals and situation, but you do miss out on the benefit of compound growth. To benefit from compound growth, which works exactly like compound interest, you would have to invest into an accumulating ETF, because this one automatically reinvests your winnings back into the ETF, thus increasing your portfolio value. I think these 4 are very good methods to begin with, because they are pretty easy to understand and they are very accessible. They are very accessible because nowadays everybody can get an app on their phone like Buck0 or Trade Republic and start investing in a matter of seconds. Now, before you go on a crazy spending spree, let me tell you about the risks of investing in the stock market and what things you always need to keep in mind. You really have to be aware that you can lose all of your money with no matter which investment method. Therefore, you should only invest the money that you can allow yourself to lose. And to not lose large amounts of money, you really have to know what you're doing and not panic sell. Panic selling is something that many people do because they didn't do proper research on a company and just invested to hop on a trend. But then, when the economy or the company itself is struggling and it gets a bit ugly, these people get really scared and just sell their shares. You should also avoid looking at your index funds and ETFs on a daily basis if your goal is to invest long term. There's no point in reconsidering your investment every day and doubting yourself, because when you first invested, you were thinking towards the future. And naturally, you should always be careful where you put your money because scams are a thing in the investment world. Congratulations, you now know quite some things about investing. However, if you want to take this seriously, which I can only recommend, you should do some courses and broaden your knowledge on this topic. I'll leave a link to the course that I used when I first started out reading and learning about the stock market and how it works. I use a website called Wall Street Survivor, which allows you to learn with videos, texts, and articles, and even some exercises on how the world of investing works. You can also set up an imaginary investment portfolio, which allows you to play with the real market numbers and see how well your investments would perform. To conclude, I would like to say that I think that your life would be more pleasurable and easier if you start learning about investing. I would say the earlier you start, the more you can benefit from investing. Your task consists in educating yourself and researching and finding the right assets to invest in. And that is all for today. I want to thank you very much for watching. I hope you enjoyed this video, and if you did, don't forget to leave a like and to subscribe. It helps more than you think. With that being said, take your finances and your future into your own hands and start exploring the world of investing. See you next time.